France faces a deepening crisis. Political instability is soaring, the economy is in chaos, and its debt is rapidly accelerating. The national budget deficit has ballooned, and the country could soon face a governmental void. For the first time ever, the French national debt has exceeded $4 trillion, surpassing the value of its entire annual economic output. While other European nations have higher debt to GDP ratios, France's situation is different. As Europe's second largest economy, it accounts for almost a fifth of the entire Eurozone. Any failure to manage its debt would send a catastrophic shockwave far beyond its borders, rippling across Europe. The warning signs have been present for decades. France has not concluded a single year with a budget surplus for over half a century. 51 straight years of outspending its income. Every government has simply covered the shortfall through continuous borrowing. This level of expenditure is unsustainable, yet every effort to reform the system triggers widespread civil disorder. Since the 1970s, older generations have seen stronger wage increases than younger workers. Now, for the first time in its history, the money paid out to retirees and pensions exceeds the total wages earned by the working population. Despite this stark reality, political action remains paralyzed. Proposals for spending cuts, tax hikes, or structural reforms are routinely introduced and quickly abandoned. The cycle repeats. A government is elected, it proposes changes, opposition erupts, the government falls, and the process restarts. All the while, France's debt escalates by thousands of euros every single second. The question now is, what happens if this trajectory continues? Should France lose control of its finances, the rest of Europe may be compelled to intervene, a scenario that would jeopardize the stability of the entire Eurozone. For the majority of the last century, France was a paradigm of affluence. It established one of the world's most generous welfare systems, comprehensive state coverage for medical expenses, unemployment benefits for those who lose their jobs, a guaranteed retirement pension, and free education from preschool through university. This commitment, the promise of state protection from every stage of life, became central to the French national identity. For decades, the model seemed to function. Economic growth was robust, living standards were high, and France established itself as Europe's second biggest economy, behind Germany. The system was lauded internationally as proof that a dynamic capitalist economy could coexist with a powerful social safety net. However, this came at a huge cost, financed through continuous debt. In fact, deficits have been the norm every single year since 1974. This reliance on debt was manageable at the beginning. Borrowing to fund growth is not inherently bad, and for decades, France was strong with the young workforce contributing to make its generous benefits appear sustainable. But these benefits became an entitlement, an expectation that the state would intervene for healthcare, pensions, and employment support. Over time, this promise became harder to uphold. By the 1990s, the ratio of workers to retirees had dropped from 5-1 to just 3-1. Pensions and healthcare began consuming a larger share of the budget, while the tax base funding them began to shrink. The creation of the Eurozone initially shielded France, driving borrowing costs down to historical lows. Politicians began relying on cheap debt instead of implementing difficult reforms, preferring to avoid sparking protests. The system appeared stable, but it was becoming increasingly fragile beneath the surface. The illusion was shattered in 2008 when the global financial crisis forced France to spend billions on economic recovery. As unemployment rose, the system's financial flow reversed, less tax revenue coming in and far more money being paid out in support. In only 2 years, France's debt soared from about 60 to 80% of GDP, a severe warning sign. However, unlike Greece or Spain, which were forced into painful bailouts, France managed to escape the spotlight and felt no urgent pressure to change. Instead of tightening its budget, the country took advantage of the European Central Bank's low interest rates, making borrowing painless again. They doubled down on debt, but the underlying conditions had changed. The population was older, the workforce smaller, and spending continued to climb. The artificially cheap interest rates concealed the escalating problems. This unsustainable gamble ended with the arrival of the pandemic. As the economy froze, France had no alternative but to pour hundreds of billions into emergency healthcare, furloughs, and state-guaranteed loans. When the crisis subsided, the debt had surged past 110% of GDP. For the first time since World War II, the country owed more than it produced. This moment broke the illusion. The French debt crisis became a tangible reality. The welfare state had become too costly to operate without continuous borrowing, and the pandemic pushed the system over the precipice. France is now stuck in a financial spiral, unable to find a clear path out. The generous welfare state was designed for an era of cheap borrowing and economic booms, a world that no longer exists. Interest rates are rising, the economy is slowing, and funding state-provided healthcare, pensions, and benefits is now significantly more expensive. France stands out as the developed nation that spends the most on its public sector. 57 cents of every euro produced goes toward public services. Last year's deficit was 167 billion euros. Crucially, over 50 billion of that amount was not spent on hospitals or schools, but simply on interest payments to service past debts. Total overspending is about 6% more than the economy generates, nearly double the EU's stability limit of 3%. The deficit continues to rise because most of France's money is committed to recurring obligations that cannot be cut without provoking a crisis. The single largest expense eating the system alive is pensions. France spends more on pensions than almost any other country, with the total price tag exceeding 350 billion euros last year, 14% of the entire economy. Pensions now cost the state more than the combined expenditure on education, defense, and transport. The fundamental problem is the shift in the balance between workers and retirees. When the system was established, less than 15% of the population were retired. That figure has already jumped to 22%. And by 2050, nearly 30% of the population is expected to be retirees. Furthermore, the average French citizen lives nearly 11 years longer than they did 50 years ago, requiring a decade more of pension checks and healthcare and support than the system was designed to handle. The French pension system operates on a pay-as-you-go basis. Beyond the decrease in workers, productivity, once among the strongest in Europe, has dropped sharply. Many young people stay in school longer to acquire advanced degrees, but the corresponding jobs are often not available. Nearly a quarter of graduates find employment that does not require their level of education. Consequently, output per worker is falling. The problem is twofold. Fewer people are shouldering the tax burden, and each one is contributing less than before. Economists, investors, and the government are fully aware that the current system is unsustainable. Yet every reform attempt leads to national upheaval. In 2023, President Macron's modest pension reform, raising the retirement age from 62 to 64, compared to 66 in the US and 67 in Germany and Italy, led to over 3 million people protesting in a single day. Strikes paralyzed transportation, garbage piled up in Paris, and the unrest persisted for weeks. Even though economists largely agreed the reform was necessary, almost 70% of the public opposed it. When Parliament resisted, Macron forced the bill through using a constitutional loophole, which only intensified public anger and caused his approval ratings to collapse. Although the reform technically passed, the political cost was enormous. Macron's party lost its parliamentary majority, making the government too weak to pursue any other significant changes. These struggles are not unique to Macron. Every previous president who attempted pension reform ran into the same political and public wall. This is the inescapable trap of the French system. Reforms are desperately needed, but any move to pass them results in political collapse or public revolt. Since 2022, France has seen 5 prime ministers, and no reform has been lasting. Investors are closely observing the rising debt, the aging population, and the politically gridlocked government. Confidence is visibly slipping. For decades, France was one of Europe's safest debtors, a productive economy second only to Germany, and lending to it was considered risk-free. However, as debt problems mount, lending is no longer cheap. France's interest rates are now rising because investors demand higher returns for the increased risk. These warnings are now showing up in financial markets. Credit rating agencies have downgraded France to its lowest score in modern history. Market confidence has cratered, so much so that it is now just as expensive for France to borrow money as it is for Italy. The numbers France is currently facing look eerily similar to past crises. Just before Greece's crisis erupted in 2010, its 10-year bonds were trading at approximately 3.3%. France is currently sitting at almost the same level. Back then, it only took a slight drop in confidence and a wave of selling for Greece's borrowing costs to spiral out of control. This is the risk France is now flirting with. As long as investors maintain faith, the system can limp along. But the moment they deem French debt unsafe, the spiral could accelerate at a frightening speed. When the Eurozone's second largest economy begins to look unstable, it undermines the stability of the entire European project. France is too large to fail. It represents 20% of the entire Eurozone. If it runs into serious trouble, a bailout might be impossible, given its 3.3 trillion euro debt pile. The euro was founded on the promise that every member state would control its finances to ensure currency stability, setting strict rules: deficits below 3%, and debt below 60% of GDP. France and others are no longer following these rules. If France cannot manage its finances, it erodes the entire system's credibility. France is simply too big to be allowed to collapse. If markets push its borrowing costs to a breaking point, the European Central Bank would likely step in to buy French bonds and prevent a panic. However, this kind of rescue would set a dangerous precedent, as other states would demand the same treatment. The Eurozone would no longer be held together by fiscal discipline, but by the ECB's balance sheet, a line Europe has never dared to cross. The uncomfortable truth is that Europe has no playbook for this. It managed bailouts for smaller economies like Greece, Ireland, and Portugal,
but France is almost 10 times the size of Greece. If France tips into crisis, the Eurozone would face an impossible choice: either execute a bailout and risk political opposition in fiscally conservative nations like Germany and the Netherlands, or refuse to act and allow one of its founding pillars to collapse. Either choice jeopardizes the euro itself.